Welcome to The Explainer. Today, we are diving deep into the core ideas of smart money concepts, pulling straight from the brilliant book, The Structural Edge by Christopher James. We're going to learn how to stop guessing and start actually tracking the smart money that really moves the market. Okay, so let's get right into it. The whole philosophy behind this way of trading is about learning to see what's basically invisible to most people. The massive footprints that banks and huge financial institutions leave all over the charts. Forget guessing. We're just going to follow the money. And just look at the difference here. On the left, that's the typical retail approach, right? It's like trying to drive by only looking in the rearview mirror using all these lagging indicators. It's so stressful because you're always reacting to something that's already happened. But smart money, over on the right, that's all about looking forward. It's about reading the market's skeleton, the raw price action, to figure out what the big players are planning right now. So how are we going to build this skill? Well, we're going to tackle it in 5 clear steps. First, we'll get the core philosophy down. Then, we'll learn the basic grammar of the market. From there, we'll decode the key signals, learn how to avoid the biggest trap that catches almost everyone, and finally, we'll wrap it all up with a solid checklist you can actually use. All right, section 1, the smart money philosophy. So, what does it really mean to see the market's skeleton? Honestly, it's about a huge mental shift. You stop seeing price charts as just a bunch of random noise, and you start learning to read them as a clear story. And every story has a plot, right? Well, the market's plot is simple. It's this constant battle between buyers and sellers. And market structure, that's the language of the story. It tells us who's winning the fight, where the price is probably headed next, and, super important, when the current trend might be running out of gas. Okay, so we've got the philosophy down. Now let's actually learn the language. Section 2 is all about getting a handle on market trends. Think of this as the basic grammar you have to know to read the story of price. You know, at any given moment, the market is always in one of just 3 states. First, you've got an uptrend. That's when the buyers are in charge, pushing price to new, higher highs, and then making higher lows when it pulls back. The exact opposite is a downtrend, with lower lows and lower highs. And finally, you get consolidation. That's when price is just chopping sideways, stuck in a range, usually while the big institutions are quietly loading up or selling off their positions. Just figuring out which state you're in is step 1. Now for the really crucial part. Once we know what the trend is, how in the world do we spot the signals that tell us it's probably going to keep going versus the warning signs that it might be about to turn around? These are basically the green lights and the yellow lights of the market. So your green light is what we call a break of structure, or just BOS. Let's say we're in an uptrend. When price pushes up and closes above the last high point, that's a BOS. It's the market literally confirming, yep, the buyers are still in control and we're still going up. It's your signal that the trend has momentum. And your yellow light, that's a change of character, or COCH. This is the very first hint that the trend might be changing. So in that same uptrend, a COCH happens when price breaks below the last low that actually created that highest high. Now, it doesn't automatically mean the trend is over, but it's a huge heads up that something is different, that the character of the market has shifted. And this image just shows it perfectly. Look at the left side. You see that bullish trend just chugging along with one break of structure after another. The story is moving along exactly as we expect, but then, bam! A bearish CHOH happens. That's the plot twist. That's the first clue that the story might be changing and the sellers could be about to take over. Now, understanding these 2 signals is an absolute game changer. But, and this is so important, applying them without understanding the proper context, well, that's the single biggest trap for new traders. It's where almost everybody gets it wrong. So what is this huge mistake that catches so many people out? It's failing to understand a very simple fact. Not all breaks in structure are created equal. There's a hierarchy to this stuff, and if you ignore it, it's a recipe for disaster. The number 1 mistake is confusing swing structure with internal structure. Think of it like this. Swing structure is like the major chapters in a book. It tells you the big, overarching story. Internal structure, on the other hand, is just the sentences and paragraphs inside one of those chapters. If you mistake a sentence for an entire chapter, you're going to have no idea what the book is actually about, right? And this right here is the golden nugget. Let's say the big picture, the higher time frame, is clearly bullish, but then you see a little bearish change of character on a 5-minute chart. The mistake is to panic and think the whole trend is reversing. It's not. It's much more likely just a small pullback, giving institutions a chance to buy at a cheaper price, a discount, before the main trend continues upwards. Getting this one distinction right changes everything. Okay, let's put it all together now. How do we take all this theory and turn it into a clear, step-by-step process that you can repeat over and over? Let's build a proper, actionable checklist. All right, let's walk through this. Step 1. First things first, identify the trend on a higher time frame. Is the 4-hour chart bullish? That's our overall direction. Step 2, mark your trading range. Where did this big move start? That's your strong low. And where did it end? That's your weak high. This is your playground. Step 3, find a point of interest, or POI. This is a specific spot in the bottom half of that range, the discount zone, where the big institutions probably left some orders. Step 4, and listen, this is the most important part. You wait. You don't just buy because price hits your zone. You wait for confirmation on a lower time frame, like a bullish chotch on the 5-minute chart. And finally, step 5. Once you get that confirmation, you execute your trade, and your target is that weak high you identified way back in step 2. If you take one thing away from all of this, let it be this. Traditional indicators are just rear-view mirrors. They tell you a story about what has already happened. Market structure, on the other hand, it's a leading indicator. It's like having a window into what the institutions, the ones with the real money, are doing right now. So this leaves us with one final question you have to ask yourself. Are you just passively watching the price go up and down, or are you actively reading the story that it's trying to tell you? Because learning to read that story, that's how you transform yourself from just another price watcher into a trader who can actually anticipate the next chapter before it's even written.